Swing trading attracts traders who want movement opportunity and feedback without the relentless intensity of day trading or the patience demanded by long-term investing. It sits in the middle ground, holding positions for days or weeks, aiming to capture meaningful price swings driven by momentum sentiment and short-term shifts in supply and demand. Yet this middle ground is deceptive. Many traders fail at swing trading, not because the strategy is flawed, but because they misunderstand what kind of discipline short-term gains actually require. Swing trading is not fast investing. It is slow trading, and that distinction changes everything. At its core, swing trading is about selectivity. You are not trying to trade everything that moves. You are waiting for situations where probability structure and timing align well enough to justify risk. This already eliminates most charts. Professionals who swing trade spend far more time waiting than trading. Beginners do the opposite. They trade frequently because they believe activity equals opportunity. In swing trading, activity is often the enemy of edge. The foundation of any swing trading strategy is market context. Short-term trades work best when aligned with the broader environment. Strong uptrends offer pullback opportunities. Downtrends offer rally failures. Choppy, directionless markets punish swing traders through whipsaws and false signals. Before thinking about entries, professionals ask a simpler question. Is this a market that rewards holding for several days, or one that demands patience and restraint? Many losses come from forcing swing trades in conditions better suited to staying flat. One of the most reliable swing trading approaches is trading pullbacks within established trends. In an uptrend, price does not move straight up. It advances, pauses, pulls back, and then continues. These pullbacks are where risk can be defined and reward justified. The trader is not predicting a new trend. They are participating in an existing one. This dramatically improves odds. The mistake many make is entering too early during the pullback itself, rather than waiting for confirmation that the trend is resuming. Another common swing strategy revolves around breakouts from consolidation. Markets spend more time moving sideways than trending. When price compresses into a range, energy builds. A clean break, especially when supported by volume and aligned with higher time frame direction, can lead to multi-day moves. However, not all breakouts are equal. Breakouts that occur after extended runs often fail. Breakouts from well-defined bases tend to be more reliable. Understanding this difference separates disciplined swing traders from those who chase every new high. Mean reversion strategies also play a role in swing trading, but they demand humility. Mean reversion assumes price will snap back toward an average after becoming stretched. These setups can be profitable in range-bound markets, but dangerous in strong trends. Fighting momentum with mean reversion is one of the fastest ways to experience repeated losses. Swing traders who use mean reversion successfully do so selectively with smaller size and quicker exits, fully aware they are trading against force rather than with it. Risk management in swing trading is non-negotiable. Because trades are held overnight, gap risk exists. News earnings, macro events, and sentiment shifts can move price beyond stops. This reality requires conservative position sizing and acceptance that not every loss will be clean. Swing traders who size too large because it's not day trading often learn this lesson painfully. Short-term gains are earned not by maximizing wins, but by ensuring losses remain survivable. Time is another underappreciated factor. Swing trades are not meant to linger indefinitely. If price does not move as expected within a reasonable window, the thesis weakens. Professionals track not just price, but behavior over time. A trade that goes nowhere while the market moves elsewhere is giving information. Capital trapped in dead trades carries opportunity cost. Knowing when to exit because nothing is happening is as important as knowing when to exit, because you are wrong. Emotions show up differently in swing trading than in other styles. There is enough time for doubt to grow, but not enough time for certainty to form. Traders check charts repeatedly, second-guessing entries and exits. This is where having predefined rules matters. Swing trading without rules turns every trade into a psychological tug-of-war. Swing trading with rules turns uncertainty into a known operating condition. Perhaps the biggest misconception is that swing trading is about catching big moves quickly. In reality, it is about capturing the middle of moves reliably. Swing traders who aim for perfection tops and bottoms experience more stress and worse results than those who accept partial participation. Consistency comes from taking what the market offers, not from demanding what it does not. The appeal of swing trading lies in its balance: enough action to stay engaged, enough time to think, and enough opportunity to compound skill. But that balance only exists when strategy, context, and risk are aligned. Without that alignment, swing trading becomes a sequence of rushed decisions stretched over days instead of minutes. And once this foundation is clear, the next step is understanding specific, repeatable swing trading setups, how to structure entries and exits around them, and how to manage trades from open to close without emotion taking over, which is exactly where we need to go next, by examining how to apply concrete swing trading setups with structure instead of impulse. Because short-term gains only become repeatable when every trade follows a familiar script. One of the most reliable swing setups is the trend pullback continuation. The logic is simple but strict. First, identify a clear trend on the daily chart defined by higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Second, wait for price to pull back into a prior support or resistance zone, often near a moving average or former breakout level. Third, enter only. After price shows signs of resuming the trend, such as a strong close back in the direction of the move, the stop is placed where the trend structure would be broken, not where it feels uncomfortable. This setup works not because it is clever, but because it aligns momentum, structure, and patience. Another common swing strategy is the base breakout. Here, price spends time consolidating in a tight range after a prior move. Volatility contracts, volume dries up, and uncertainty builds. The opportunity comes not from guessing the breakout direction early, but from waiting for price to leave the range decisively. Clean breakouts that occur in the direction of the higher timeframe trend and are supported by expanding volume have a higher chance of follow-through. Risk is defined at the edge of the base, and targets are modest, aiming for the middle of the next expansion rather than the extreme. A third setup is the failed move reversal, often misunderstood and misused. This occurs when price attempts to break a key level and fails, quickly trapping late participants. These trades can be powerful, but they demand experience and restraint. The failure must be clear, fast, and confirmed by rejection rather than hesitation. Stops must be tight, and size must be smaller, because you are trading against the most recent momentum. This is not a beginner's setup. Professionals use it sparingly, not as a primary strategy. Managing swing trades is where most profits are actually made or lost. Once in a trade, the job shifts from analysis to execution. Predefined rules matter here. Partial profits may be taken at logical levels to reduce emotional pressure. Stops can be adjusted only when structure changes, not because fear increases. If price moves as expected, patience is rewarded. If it stalls or violates, structure exits are executed without negotiation. Swing trading punishes indecision more harshly than bad analysis. Time stops are an underrated tool. If a trade does not begin working within a reasonable number of sessions, the probability of success declines. Exiting flat or with a small loss frees capital and mental energy. Professionals respect opportunity cost. They do not stay married to ideas that the market is ignoring. The final ingredient is review. Swing traders who improve do not just count wins and losses. They study charts before, during, and after trades. They look for patterns in their mistakes, entering too early, ignoring context, oversizing, or moving stops emotionally. Over time, this feedback sharpens intuition and reduces noise. Skill compounds when behavior is refined deliberately. In the end, swing trading strategies for short-term gains are not about speed or excitement. They are about rhythm. Waiting, acting, managing, exiting, and waiting again. Traders who respect this rhythm survive long enough to let probability work in their favor. Those who rush it turn swing trading into stress, stretched over days instead of minutes. If this breakdown helped clarify how swing trading should actually be practiced, consider subscribing to Stay with these long-form discussions, focused on structure over shortcuts, and leave a comment, sharing which swing setup you feel most drawn to. And why? Because understanding that preference often reveals both your strengths and your blind spots.